Welcome back, everybody. So today we're going to do something a little different. I'm actually going to pour myself a drink. We're going to hang out, have some fun, and I'm going to answer some viewer comments because there have been some really great ones recently, especially about things that I've been doing, whether they're critical or just asking questions. And I think it would be worth it to just kind of go through them, give me a chance to kind of clarify a couple things and just kind of have some fun with it. And I have my glass, I have my ice in my glass, and I have today's video sponsor, but no, I'm kidding. They didn't sponsor the video, but I do like drinking it. It's Bullet Bourbon. I don't know if you guys like it. I'm not an expert. It's not one of those things where I'm like, oh, I taste, hints of oak wood. All I know is I like how it tastes and I drink it. I'm not an expert. But anyway, if you know someone from Bullet Bourbon, they want to sponsor a video, let me know. All right, let me actually pour this. Cheers. And just for clarity, you guys know that whenever I share comments on my channel, I always blur out the person's name because one, I don't ever want to assume that a person's okay with me sharing it, even though I know that they publicly commented on my video. But two, I don't want anyone to get upset or feel like they're being targeted if they say something critical about me, because that's not what it's about. Like, I want you guys to keep commenting. I want you to keep challenging or asking questions about what I'm doing, because it helps me too. I have to actually think about, how my stuff comes across, how I'm presenting it, and really reflect on if what I'm doing is what I'm telling you I'm going to do. I don't want you to feel like, oh, I don't want to comment on Matt's video or question him because if I do, I'm just going to be put up on the screen on the next video. That's not what it's about at all. So I don't share the name. That's why. There are a couple exceptions that we'll get to in this video, but it'll make complete sense as to why I do it. All right, enough of the talking. Let's get to the comments. So first comment, I feel like you do a little too much trading to truly call yourself a value investor. Now, I get different flavors of this comment. It's you're not truly a value investor, you're not a real dividend investor, you're not a long-term investor, and it's all kind of the same concept. So the first thing that I'll say about this is I don't ever remember calling myself kind of any of these labels. I don't think I've ever called myself a value investor. Even though I look for companies that are dividend growth companies in general, I wouldn't consider myself a quote unquote dividend investor. I just look at myself as an investor. Now, I would consider myself a long-term investor, but again, if something changes or I have a different idea and I want to make a change or get out of something or buy something, then I'll go ahead and do that. And I think you guys have seen that. So, you could maybe argue that had I just held on to things that I bought instead of trying to trim and get out of them, that maybe I would do better. I think that's a fair criticism. But, in general, I don't necessarily prescribe to any one label. Like, at the end of the day, I'm going to make decisions based on my own personal strategy and goal. And I would expect that you all do that as well. And whether you want to label that value investing or dividend investing or whatever, I think that's a personal choice. I don't personally view it that way or think about it that way. So how I look at it is, you can call whatever I'm doing whatever you want. It doesn't bother me, but I don't really call it any one thing. So I don't consider myself a value investor because what people consider value is different, right? So I base it on my own personal strategy, the criteria that you guys see in all of my videos, and that's just how I define it. I don't define it any other way. So let's get to the next one. Are you sure that trimming SCHD is smart? Would like to see if you can outperform it in the medium and long term. Now, first of all, I don't know that anything that I'm doing is quote unquote smart. We'll only know over time because results matter, right? But I know that SCHD is a very popular topic, especially with people on my channel, because a lot of you guys were introduced to me with that initial SCHD video. But it's really about the core criteria that SCHD uses versus my own personal strategy and goals, right? And the issue there is one of my goals is I want to be able to beat the S&P 500. Now, obviously, last year I kind of lagged the S&P 500, and there's a bunch of reasons why that could be. It's not just about SCHD. But when you have 20% of your portfolio, which is what I had, in an ETF that prioritizes current yields, that is usually going to make it a little bit harder to compete with the S&P 500 over the long term, at least in my opinion. Me trimming SCHD was about having more control, getting that extra 10% of my portfolio into stocks that I'm personally picking as opposed to what their algorithm of the index is picking. And that's really what it's about. It's not about if it's smart or not smart. I don't know. Time will tell if it's smart or not, but it's about me getting more control over my stock picks to try to beat the S&P 500. I feel like I can't even talk already. I'm only on the second question, and I barely even touched this yet. So who knows where this is going to go? All right, so up next, this is kind of around the same type of question. It says, so you trimmed both value, SCHD, and defensive stocks, UNH. You sold the discounted prices, and you bought growth stocks close to all-time high, Apple, Amazon, and Visa. This looks a bit like FOMO investing. It's better to be patient as these growth stocks are overbought right now. Correction is due soon. So I don't think about it like, oh, I trimmed a value ETF and I trimmed a defensive stock. I look at it as I trimmed an ETF to get more control over the individual stocks that I pick for an additional 10% of my portfolio. And I trimmed a healthcare stock that has some headwinds related to its industry and its own rising costs that made me a little bit concerned to where I didn't want it as my top holding. And so to me, that seems very logical, even though kind of on the broad strokes of value versus defensive versus growth, it looks like, maybe something different. But on the second part, they said that I bought growth stocks at close to all-time highs like Apple, Amazon, and Visa, and it looks like I'm FOMO investing. Now, Apple, I will give you that one. Apple was an outlier, and I've talked about it many times on the channel as to why I bought when I did. I had kind of a estimated guess, educated. Wow. How much of this have I had? We don't know. You don't know. I know. You don't know because this is a video. Anyway, so I had an educated guess in terms of, what they would do with earnings coming up at the time. And my guess was wrong, and I paid the price for that in terms of the price that I bought at. It has, had gone down quite a bit after that. But the main thing that I wanted to talk about with this is anytime we talk about a stock being at all-time highs, we say, hey, you bought at an all-time high in terms of price. Like that's what everyone talks about. But really, that doesn't make a lot of sense, especially if you're talking about investments where you're really looking at fundamentals and you're looking at valuation to decide when is a good time to buy. Now, again, for Apple, I'll give you that one. When it comes to price to cash flow, it was at an all-time high, even as it relates to value, which was probably the biggest issue with it. But when you look at Amazon and Visa, I would argue that I bought those at very attractive times, even though from a price perspective, it looked like they were close to all-time highs. Because Visa was at a price to cash flow of 25, which was actually attractive based on their 10-year history. And they had just experienced about 2 years of multiple compression down from a price to cash flow of 47 in 2021. And Amazon was at a price to cash flow of 19 when I bought, which is one of the lowest of the last decade for them. And even after they shot up in earnings, their price to cash flow is still really attractive, which is why I've actually already bought more of Amazon as of today, but we'll talk about that in a future video. But the point that I'm trying to make is people will see Amazon be at an 80 PE, or they'll see, Apple and Visa be at all-time highs in terms of price, and they'll just assume that you're FOMO investing. So again, Apple, I'll give to you, right? Like that was a decision that probably could have been a better decision. But Amazon and Visa, I think we're at very attractive value ranges, which is more important than price, at least to me. And so far, they've been great decisions. All right, let's get to the next one. And I tend to get these type of comments pretty often. And this was on my post about Amazon and how it had gone up a bunch after earnings. So you're telling me that a year ago, when the stock was at $80, you didn't think the stock was at massive discount with room to grow? And then, basically laughing at me. So these type of comments happen all the time. And there's a few points that I want to make about it. So one, people kind of assume that, the goal is to buy the bottom on a stock, or it's some badge of honor, right? Like you bought it at the absolute bottom and it only went up. It means you're a genius or whatever it means. To me, that's not really my goal at all. And I'll explain a little bit more why it matters later. It's easy to look back on a chart and say, oh man, you should have bought right there because that was the bottom and it only went up from there. And we do this all the time. It's human nature, right? I do it too. But we can't trade the middle of the chart. That was actually a quote from a great book by Alexander Elder. It's called Trading for a Living, which it's about trading stocks, which is not, the point of this video or this channel, but it is a really good book about that. And it's more about like human psychology and stocks, which I think is fascinating. But he had this quote in there that was like, Your broker won't allow you to trade the middle of the chart. You have to trade at the far right of the chart. And you have to try to decide or guess what's going to happen next. It's not nearly as easy as it looks in hindsight. But not only that, companies change over time. Like every time they have a quarterly release, their fundamentals change. You have to kind of relook at the progress that they're making or the things that you expected to happen. So just assuming that a stock was a certain price a year ago doesn't mean that it was the same business a year ago. You actually have to dig into the details to know that for sure. And I'm going to give you an example right now. So on December 28th, 2022, when Amazon was at around $80 at its lowest, it had a price to cash flow of 21 and a price to earnings of 73. And if you actually looked at their segment profitability, you would have been able to see up to Q3 of 2022 data, which you can see on this chart. Only one of their three segments was profitable, and that was AWS. But even AWS at the time had seen its second straight quarter of declining operating income. And the other two segments were going on almost a year of not being profitable. Now, fast forward to January 16th of this year, 2024, when I added Amazon, and it had a price to cash flow of 19 and a price to earnings of 53. And I was able to see up to Q3 2023 of segment data. And you can see on the chart that AWS has had two straight quarters of rising profitability by then, and the North America segment went from unprofitable to almost half of AWS's profitability. Plus, their profitability was still rising with more good things on the way, which we saw when they announced Q4 earnings last week. So in hindsight, it's easy to look at the price chart and say, oh, look, a year ago it was at $80. Why didn't you buy then? It was the same company. Because it wasn't the same company, and that's the whole point. When Amazon was at $80, it had a higher price to cash flow, a higher price to earnings, and financials that hadn't yet proven that their efficiency investments would actually work. At that point in time, Amazon was more of a turnaround play than anything. You had to actually believe that they were going to come back because it wasn't in the data yet. And if you did, that's amazing. Like, great job. You crushed it. It's pretty much doubled from then. But some investors want to see the progress first before they invest, even if that means they miss out on the bottom as it relates to price. So sure, I paid more in price per share when I bought a few weeks ago in January, but what I actually got in terms of value in cash flows was more than I would have got had I bought it at 80 a year ago. And people may not like it, but that's how it actually works. My ice is melting, which means that I'm talking too much. Oh, and this one's actually one of my favorites. This is the oof, didn't you buy it 170, bro? So this is another one that I frequently get. I get this style of comment quite a bit. This particular comment was on my American Express analysis video where I basically said that I was still buying it. And I think it was from like July of last year. I was still buying it in the 170s. And this comment was like a few months later. It was in October when Amex had basically, dropped down to like 140. Now, in general, my Amex position started in May of last year at around 150. But the point of that video was saying, look, it's at 170 and it still looked undervalued to me at the time. So I was still adding at that point in time. And then, of course, when the market tanked in October and everything was down, it was down to like 140. But here's the thing. This is the nature of the beast, right? Whenever you post your portfolio online or you kind of make these trades or these buys and sells online. And the reality, though, is that this type of thing happens in real life. Like, you might not be posting all of your buys and sells, but anytime you talk about investing with anyone, this type of thing comes up. Because if you bring up a stock and someone's like, oh, I didn't buy that, or I bought this, or that's super overvalued. Like, we've talked about this before. This is kind of like a natural reaction anytime we try to talk about stocks to pretty much anyone out there, right? Which makes learning about investing and stock investing really hard. These things are just point in time reactions, and we shouldn't get too high or low about, price, or if someone says, oh, you're an idiot, you bought it 170. All that stuff doesn't matter, right? What matters is that we're constantly using our own criteria. We're constantly using our own kind of strategy and goals to drive our decisions. And what somebody thinks about that, or what the market even thinks about that in a moment in time, is less important than, us being able to follow the own structure that we've created for ourselves. Because the hope is that over time, it's going to be rewarded, right? Even if it's not in that exact moment. So yeah, here we are. American Express is at 205 now. This doesn't even matter anymore. And all I have to say is I hope that that person is doing well, and I hope that they at least were able to pick up some shares along the way, because otherwise, oof. All right. So next one, the stocks that beat the S&P, will you sell or will you long hold? So this is a really good question in terms of the stocks that outperform. Am I going to get rid of them once they outperform? I touched on this a little bit earlier. It really just depends on the business, right? I have stocks that I plan to hold for a very long time, and hopefully they do outperform and they continue to outperform kind of year after year. Others where it's more of I have a specific idea of them being undervalued or having some kind of, prospects over the next year or two that are really good. And then once they get to a certain kind of normal valuation, then I'll revisit kind of their growth prospects and their valuation at that time. And, if it means that I need to trim some of those, then I will. Or if I need to get out of them, then I will. But it just depends on each individual stock. It's not really related to if they beat the S&P or not. It's more about kind of, is my story related to that stock? Has it been realized? And if it is, then, maybe it's time to move on. So on the next one, it says, did you add to McDonald's today after earnings? I'd like to add more to McDonald's, but my average cost is $2.34. And today wasn't much of a dent to get me to that level to where I want to start adding to that. So McDonald's dipped about 3 to 4%, this week after earnings. And I didn't actually add to my position in McDonald's this week. I did add to my Visa position last week, though. And, when it dipped about 3%, a little less than 3%. So, what I wanted to talk about is how do I evaluate why I added to Visa, but I didn't add to McDonald's, even though they dipped roughly the same amount, or actually McDonald's dipped even more than Visa did. And that kind of blends into this other comment that I got about what is Amazon's intrinsic value. And it says, Matt, based on your calculation, what is Amazon stock intrinsic value? Now, I don't really calculate specific values for here's what I think a stock is worth. Now, you guys, if you've seen my stock analysis videos, you know that I actually go through kind of the traditional valuation models, DCF, the multiples models, just to get a ballpark of what it might be kind of using those traditional methods. But I don't really use those specific prices as like a guide to say, oh, I'm going to buy at this price. I don't really do that because I don't feel like it works well for me. Here's what I do instead. I tend to use a combination of a couple things to determine if a stock's at a good valuation. One, historical price metrics, ideally price to cash flow, but sometimes I'll use price to earnings as well. Plus what I believe their actual growth prospects are for growing cash flow or, of course, earnings per share. And I can give you an example of what I mean. Like Amazon just a couple weeks ago, when I bought it, their price to cash flow was around 22, 23, and it looked attractive based on their history and their 5-year average, because that was around 27. Now, their cash flow had been growing rapidly, even with the increases in CapEx and stock-based compensation, and they had even more growth prospects on the way. They have margin expansion in retail, advertising growth, and the addition to Prime Video, growth in higher margin revenue streams, like all those things that I've talked about with Amazon were all there. So even if I just expected a reversion to the mean for their price to cash flow to get back around that 5-year average of 27, that's a 17% increase from where it's at, assuming that the cash flows just stayed the same. But then if you include all the potential growth prospects, then that looks significantly better than the 17% opportunity. So for me, I view that as very attractive and undervalued. The reason why I don't try to calculate a specific number is because then I get caught up in the stock hitting a specific number. Like, oh, when it hits 150, I'm going to buy, right? But then it may never hit 150 because that's just some number that I made up with my own personal assumptions in some spreadsheet, right? So what I try to do in general is just say, okay, is it undervalued based on these kind of general principles of historical price metrics and growth prospects? And if it is, then go ahead and buy or feel comfortable buying. And, hopefully over time, those things play out, whether that's that additional growth in cash or that kind of multiple expansion or reversion kind of to the multiple mean or some combination of those things. So if I go back to look at the Visa versus McDonald's thing, if you look at where McDonald's is at right now, its price to cash flow is still pretty elevated, especially when you compare it to where I last added to that position back in October. And while I think their growth prospects are still good, they're not quite as good as Visa's are right now. And if I look at Visa, when it dipped, its price to cash flow looked more attractive still, Plus, they have double-digit growth prospects on the top and bottom lines. So I ended up adding to Visa and not McDonald's. And hopefully that all makes sense. Now for these next ones, I just want to let you guys know, I love the comments that you put on there where you're, in another country and you're kind of representing your country and greeting me from your country. I love those comments so much. First, evening from the UK. Greetings from Bogota, Colombia. Greetings from the Netherlands. Greetings from Portugal. Like, I just love seeing these. A little history about me, if you guys, I don't think I've actually talked about this. I was a military brat growing up. My dad was in the Air Force for like 20 plus years. So we moved a lot every 2-3 years. I lived all over the US and actually lived in Germany twice. We lived at Ramstein Air Force Base in Germany. So I was very lucky enough to see quite a bit of Europe as a young child and then as like a young adult. And that was really great. It was an amazing experience. At some point, I want to take my family back there so that they can experience it too. But I get excited anytime that I see y'all's comments from your countries because it's cool. It's amazing to me that anybody watches my channel, but especially folks who are in other parts of the world and are getting some value out of it. So much appreciated. I love the comments. Keep them coming. I got this comment, and I'm going to break my rule just a little bit of not showing the person's name. I'm actually going to show this person's name, and you'll see why here in a minute. So Southpaw 13100 said, I bought Matt's one share of Realty Income, and I loaded up on some REITs in December, trying to get 6% exposure to real estate in my portfolio from 0%. I just wish that Matt would have had more for sale. So Southpaw 13100 snatched up my one share of Realty Income. They're building up their real estate portfolio, which is awesome. I'm sorry that I only had one share to sell you, but congrats on getting that one share because as we all know, that is a very hardworking share. It's probably a share that's going to make you rich. So Southpaw, this is for you.
I'm rich.
I love that meme so much. It's great. I brought it back. I had to. All right, on to the next one. Just want to add this one comment in here because I appreciated it. Anyone that watches the channel and isn't signed up for the newsletter is doing yourself a disservice. Highly recommend. And I've gotten a couple comments like this, and it's awesome. I really appreciate it because I just started the newsletter pretty much this year. And it's, like weekly, and I talk about markets and stuff. And if you don't want to wait for the portfolio updates every month to know what I'm doing with my stocks, my buys and sells, and why, my thought process behind it, then definitely sign up for the newsletter because I talk about it. Anything that happens in the past week gets put into the newsletter. And so the stuff like the Amazon buy, the, UNH sell, all those things were in the newsletter before it was even in a video. And also add some personal stories in there, some other things just to try to make it a little bit more interesting. But if it's something that you want to check out, the link's down in the description. All right, this is the last comment, and I'm going to, again, ignore my rule of not showing the person's name because you'll understand why here in a minute. And this was on my Amazon video, but congrats, I did the same. I made a video the same day as you. Wish I could have the exposure that you do. One day. So first off, Jordan, believe it or not, it wasn't all that long ago that I was where you were at and just trying to get people to watch my videos. And I've talked about it a bunch that as of July of last year, I was still under 1,000 subs after posting for over a year. But we've grown from 900 subs to over 21,000 subs in the last 7 months, which is pretty insane. So I've definitely been incredibly lucky, and I'm really, really grateful for that. So I'm going to try to pay it forward at least a little bit today. Now, Jordan, I haven't had a chance to watch your videos yet, so I'm just going to assume and trust that you're not doing anything crazy over there. But anybody that wants to check out Jordan's new channel related to stocks, search for @JordanInvestment or Jordan's Investment Journey on YouTube. Now, I can't vouch for your channel yet, Jordan, because I haven't had a chance to watch it, but I know how hard it is when you're starting a channel, just trying to get people to check it out, watch your videos, and give you some feedback. So hopefully you at least get a few people from my channel to check out yours. And once they go there, the rest is up to you, my friend. Good luck. Okay, so that was me answering some viewer comments. Let me know if you actually like this type of video. It's a little bit longer, a little less edited, but I thought it was fun. But then again, I have a little fun hack right here that you may not have, so that's obvious. But if you want to know more about my personal backstory, I did kind of a similar type of Q&A video back towards the end of last year, and I go through it a little bit more there. So if you want to check that out, click on this video right here. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you guys in the next one. Peace. I just realized that I still have the tag on the bottom of the glass. from when we bought it. We've probably had this for like 2-3 years already. It's amazing.